Picture this. Every day, trillions of dollars flow through global markets based on the assumption that the US dollar's dominance rests on economic fundamentals and military strength. Yet the actual mechanisms keeping that system intact operate through agreements most people have never heard of and dependencies that contradict basic market logic. The world's most powerful currency maintains its position through structures that, by conventional economic theory, should have collapsed decades ago. This discussion is for educational and analytical purposes only and does not constitute financial advice. When most analysts examine dollar dominance, they point to America's economic output, military presence, or technological leadership. These explanations feel intuitive because they align with how we think power should work. Strong economy equals strong currency. Global military reach equals global monetary influence. Innovation leadership equals financial control. But here's what that narrative misses. The dollar's actual grip on global finance operates through a web of artificial constraints and recycling mechanisms that have nothing to do with underlying economic strength. Countries that could theoretically abandon the dollar system find themselves structurally unable to do so, not because America produces the best goods or services, but because the exit costs have evolved to exceed the incentives for leaving. Consider the mathematics. The United States runs persistent trade deficits, meaning it imports more than it exports year after year. In traditional economic theory, this should weaken a currency as supply exceeds demand. Instead, the dollar has strengthened against most global currencies over the past decade. The mechanism creating this contradiction isn't economic performance, it's systematic demand generation through commodity pricing requirements and reserve recycling agreements. The implications extend far beyond exchange rates. If the dollar's dominance depends on artificial structural supports rather than economic fundamentals, then current market pricing reflects a misunderstanding of what maintains global monetary stability. Investors allocate capital based on assumptions about American economic supremacy when the actual foundation operates through entirely different mechanics. Most importantly, these support structures aren't permanent features of the global economy. They're agreements between specific parties under specific conditions. When those conditions change or when alternative systems reach sufficient scale, the artificial demand that keeps the dollar system intact faces pressure that pure economic fundamentals cannot address. And the reason this hasn't been reflected in price yet is not what most people assume. The widely accepted story begins with World War II and the Bretton Woods Conference. 44 nations gathered in New Hampshire in 1944 to rebuild the global monetary system. The United States emerged from the war holding 3/4 of the world's monetary gold reserves while Europe and Asia lay in ruins. The agreement seemed straightforward. Countries would peg their currencies to the dollar, and the dollar would remain convertible to gold at $35 per ounce. This created stability and predictability for international trade while positioning the dollar as the central reserve currency. The system worked because America had the gold to back it up, and the economic capacity to honor convertibility. For 2 decades, this arrangement functioned exactly as designed. Countries accumulated dollars for trade and held them as reserves, confident they could exchange those dollars for gold if needed. The United States maintained price stability and fiscal discipline to preserve confidence in convertibility. Global trade expanded under the predictable exchange rate system. Then came the contradiction that revealed the system's true nature. By the late 1960s, persistent US budget deficits from Vietnam War spending and domestic programs created more dollars in foreign hands than the United States had gold to cover. The mathematics was simple. Foreign dollar holdings exceeded $600 billion, while US gold reserves sat at around $10 billion. Full convertibility had become mathematically impossible. President Nixon faced a choice in 1971. Either impose severe austerity to reduce the dollar supply and restore convertibility, or abandon the gold standard entirely. He chose abandonment, ending dollar convertibility to gold and effectively terminating the Bretton Woods system. By conventional economic logic, this should have triggered massive dollar selling as the currency lost its fundamental backing. Instead, something unprecedented happened. Rather than seeking alternatives, the global economy doubled down on dollar dependence through an entirely artificial mechanism. Within 4 years, a new arrangement emerged that created structural dollar demand regardless of underlying economic performance. The petrodollar system represented a complete departure from market-based currency adoption. Unlike previous monetary arrangements that evolved through trade efficiency or resource backing, This system was explicitly negotiated between the United States and Saudi Arabia. The agreement was simple in concept but revolutionary in implementation. Saudi Arabia would price all oil sales exclusively in dollars and reinvest surplus revenues in US government securities. In exchange, the United States would provide military protection for Saudi oil infrastructure. By 1975, every OPEC member had agreed to similar arrangements. Oil, the world's most traded commodity, could only be purchased with dollars, regardless of the buyer's domestic currency. This created immediate non-optional dollar demand for every oil-importing nation. Countries that previously held dollars by choice now held them by necessity. The mechanism operated with mathematical precision. Global oil consumption required approximately $2 trillion in annual purchases by the early 21st century. Every barrel purchased, every futures contract settled, every strategic reserve filled demanded dollars first. Nations had to earn, borrow, or buy dollars before they could access energy markets. If you're interested in understanding markets beyond headlines, this channel focuses on exactly that. This wasn't simply about oil transactions. The petrodollar system created a recycling mechanism that directed surplus revenues back into dollar-denominated assets. Oil-producing nations accumulated far more dollars than their domestic economies could absorb. Rather than converting these surpluses to local currencies, which would have pressured the dollar downward, the surpluses flowed back into US Treasury securities, corporate bonds, and real estate. The numbers reveal the scale. Saudi Arabia alone accumulated over $700 billion in foreign reserves, predominantly dollar-denominated. The UAE, Kuwait, and Qatar built sovereign wealth funds exceeding $1 trillion in combined assets, again primarily in dollar instruments. These weren't market-driven investment decisions. They were structural requirements of the petrodollar arrangement. Meanwhile, the dollar's role expanded beyond energy into nearly every major commodity market. Wheat, corn, copper, gold, silver, and most industrial metals traded in dollars regardless of where they were produced or consumed. A Brazilian company selling soybeans to China conducted the transaction in dollars, creating artificial demand that had nothing to do with American economic activity. This is the part most people understand. The part that actually changes the outcome comes next. If dollar dominance depended on economic strength alone, much of this system would not need to exist. The petrodollar system created something that had never existed in monetary history, a currency whose dominance was maintained through artificial scarcity rather than economic performance. Countries needed dollars not because American goods were superior or because American markets were most attractive, but because essential global transactions were denominated exclusively in dollars. This artificial scarcity mechanism operated through multiple layers. First, the commodity requirement layer forced immediate dollar acquisition for energy and materials. Second, the reserve recycling layer captured surplus dollars and redirected them back into dollar-denominated assets. Third, the financial infrastructure layer routed international payments through dollar-based systems regardless of the underlying transaction currencies. The Society for Worldwide Interbank Financial Telecommunication, known as SWIFT, became the central nervous system for this dollar-centric infrastructure. Though technically a messaging network rather than a payment processor, SWIFT's protocols were designed around dollar transactions. By 2020, 40% of the 42 million daily international payment instructions involved dollars, even when neither party to the transaction was American. This created a dependency that transcended individual country choices. A German company purchasing Japanese machinery might prefer to transact in euros or yen, but the international banking infrastructure made dollar transactions more efficient and less costly. The network effects became self-reinforcing. More dollar usage improved dollar infrastructure efficiency, which encouraged more dollar usage. The reserve accumulation requirements added another layer of artificial demand. Central banks worldwide held approximately $7 trillion in foreign reserves by 2020, with nearly 60% denominated in dollars. These weren't investment decisions based on expected returns. They were insurance policies against currency crises and balance of payments emergencies. Here's where the system revealed its true constraint structure. Countries could theoretically abandon dollar reserves and dollar-based trade, but the transition costs exceeded the benefits for individual nations. Moving away from dollar systems meant accepting higher transaction costs, reduced liquidity, and potential isolation from global financial networks. The mathematics worked against defection. A country holding substantial dollar reserves faced immediate losses from currency conversion. A country avoiding dollar-based trade faced higher costs and reduced market access. The system was designed so that collective action could theoretically break dollar dominance, but individual action was economically irrational. Even more subtle was the debt trap mechanism. Developing nations borrowed heavily in dollars during periods of dollar weakness, when borrowing costs appeared manageable. When the dollar strengthened, as it cyclically did, debt service costs increased dramatically. This forced these nations to earn more dollars through exports or reserve drawdown, creating additional artificial demand. The irony was mathematical. The same system that created artificial dollar demand also created the conditions that would eventually undermine it. Every sanction applied through dollar-based systems gave targeted countries incentives to develop alternatives. Every use of financial infrastructure as a geopolitical weapon reduced trust in that infrastructure's neutrality. On the surface, everything still appeared to make sense. By 2015, however, a new reality was becoming visible in global finance. Countries that had accumulated large dollar reserves began to realize that access to those reserves depended not only on ownership, but on continued access to the financial infrastructure through which they were held and moved. The same systems that made dollar dominance efficient under normal conditions could, under existing legal and geopolitical frameworks, restrict access when relationships deteriorated. A series of high-profile financial sanctions clarified how this structure operated in practice. When certain countries were removed from SWIFT messaging systems, their ability to conduct international commerce deteriorated rapidly. Banks could no longer transmit payment instructions. Trade finance stalled. Even routine transactions involving foreign counterparties became difficult to execute. This was not abstract economic pressure, it was an operational constraint. Dollar dependence revealed itself as infrastructure dependence, where continued participation in global finance relied on compliance with rules governing system access. The realization spread quickly. Foreign reserves, while still recorded on balance sheets, could become functionally inaccessible through administrative processes rather than market price movements alone. The mathematical reality was stark. A country holding $600 billion in dollar reserves faced potential losses exceeding its annual economic output if those reserves were frozen. But converting those reserves to alternative currencies created immediate market pressure that could trigger the exact financial crisis the reserves were meant to prevent. The system had evolved into a sophisticated trap where the exit costs exceeded the risks of staying. Meanwhile, the actual mechanics of dollar creation revealed another layer of contradiction. The United States was printing dollars at unprecedented rates to fund deficit spending, yet global dollar demand continued increasing because the structural requirements for dollar usage grew faster than dollar supply. Quantitative easing programs that should have weakened the dollar instead strengthened it as international demand absorbed the additional supply. Central banks worldwide found themselves in an impossible position. They needed dollars for international trade and reserve requirements, but accumulating dollars meant accepting currency risk from American monetary policy decisions over which they had no influence. Countries that tried to reduce dollar exposure faced immediate increases in transaction costs and reduced access to global markets. The debt dynamics added another constraint layer. Emerging market corporations had borrowed over $11 trillion in dollar-denominated debt by 2020. When the dollar strengthened, debt service costs increased automatically regardless of the borrower's domestic economic performance. This created forced dollar buying during exactly the periods when those countries could least afford additional dollar exposure. The system had become self-perpetuating through what economists call network externalities, but with a crucial difference. Traditional network effects create value for users as more participants join. The dollar system created dependency that was costly to escape as more participants joined. Each additional country using dollar-based trade infrastructure made it more expensive for any individual country to develop alternatives. Consider the practical constraints facing any nation attempting to reduce dollar dependence. Alternative payment systems required critical mass to achieve efficiency. But achieving critical mass required multiple countries to absorb transition costs simultaneously. The coordination problem made collective action nearly impossible, while individual action remained economically irrational. The energy sector illustrated how these constraints operated in practice. Oil contracts weren't just priced in dollars, they were structured around dollar-denominated credit facilities, insurance policies, and settlement systems. A country attempting to purchase oil in alternative currencies faced not just price premiums, but counterparty risk as sellers struggled to hedge non-dollar transactions through established financial infrastructure. Gold markets provided another example of hidden dollar dependence. Though gold trades globally, the major pricing benchmarks, futures contracts, and settlement systems operated through dollar-denominated exchanges. Countries accumulating gold as a dollar alternative discovered their gold holdings were still subject to dollar system volatility through the pricing and trading infrastructure. Even bilateral trade agreements designed to bypass dollar systems faced practical obstacles. Two countries agreeing to trade in local currencies still needed mechanisms for exchange rate determination, payment settlement, and dispute resolution. The dollar system provided standardized solutions for these problems, while alternative arrangements required costly custom infrastructure development. The derivatives markets added exponential complexity to any exit strategy. Currency hedging, interest rate swaps, and commodity futures contracts totaling over $600 trillion in notional value were structured around dollar reference rates and settlement procedures. Unwinding exposure to dollar-based derivatives created cascading requirements for additional dollar transactions, even when the underlying economic activity involved no American participants. Financial institutions faced their own constraint structure that reinforced dollar dependence at the operational level. International banks needed dollar funding to serve clients engaged in global trade, but accessing dollar funding required compliance with American regulatory oversight regardless of the bank's home jurisdiction. This created a regulatory web that extended American financial authority far beyond American borders. The technology infrastructure underlying global finance had evolved around dollar transaction patterns. Payment processors, settlement systems, and regulatory reporting platforms were optimized for dollar-based workflows. Alternative currency systems required not just different software, but different operational procedures, staff training, and regulatory compliance frameworks. Insurance and credit rating systems added another dependency layer. International trade insurance, political risk coverage, and credit facilities were structured around dollar-denominated exposures and American legal frameworks. Companies operating outside dollar systems faced higher insurance costs and reduced access to credit facilities, creating competitive disadvantages that accumulated over time. Even sovereign wealth funds and pension systems found themselves structurally locked into dollar dependence. These institutions required liquid, deep markets for asset allocation and risk management. Alternative currency bond markets lacked the depth and liquidity necessary for large-scale institutional investment, forcing continued dollar exposure regardless of strategic preferences. The legal framework surrounding international contracts created additional exit barriers. Commercial disputes, arbitration procedures, and enforcement mechanisms were structured around dollar-denominated settlements and American legal precedents. Abandoning dollar systems meant accepting reduced legal protections and enforcement capabilities for international business relationships. By 2020, the dollar system had evolved beyond a monetary arrangement into a comprehensive infrastructure that touched every aspect of international commerce. Countries weren't just choosing a currency, they were choosing access to financial infrastructure, legal frameworks, and operational systems that had no equivalent alternatives at comparable scale or efficiency. The mathematical precision of this constraint structure became apparent during periods of dollar strength. When American monetary policy tightened, dollar funding costs increased globally regardless of local economic conditions. Countries with substantial dollar debt faced automatic tightening of financial conditions that could trigger domestic recessions through no domestic policy failures. The feedback mechanisms ensured that alternatives remained perpetually underdeveloped. Any country or institution that attempted to build non-dollar infrastructure faced immediate competitive disadvantages that limited their ability to attract the participation necessary for system viability. The dollar system's incumbency advantage wasn't just about convenience, it was about survival in global markets. Yet beneath this apparent stability, stress indicators were accumulating in ways that traditional market analysis consistently overlooked. This is where the same forces that drove growth begin to reverse. The stress fractures weren't random market volatility. They were systematic responses to mounting operational contradictions that had been building within the dollar infrastructure itself. Countries began experiencing what economists call liquidity traps, but not in the traditional sense. These were structural liquidity traps where accessing dollar funding required accepting surveillance and control mechanisms that contradicted national sovereignty. The first visible cracks appeared in trade settlement patterns. Bilateral agreements to conduct commerce in local currencies had existed for decades as symbolic gestures toward monetary independence. By 2018, these arrangements began handling material transaction volumes for the first time. Russia and China settled over 80% of their trade in rubles and yuan. India negotiated rupee-based settlements with multiple trading partners. These weren't policy statements. They were operational necessities driven by infrastructure access restrictions. Central banks started accumulating gold at rates not seen since the 1970s. The purchases weren't driven by investment strategy or inflation hedging. They represented insurance against reserve freezing mechanisms that could render dollar holdings worthless through administrative action. Gold offered the only major store of value that existed outside digital infrastructure controlled by dollar system operators. The mathematics of reserve diversification revealed the constraint structure's vulnerability. When multiple countries attempted to reduce dollar exposure simultaneously, the collective action created exactly the coordination effects that individual action couldn't achieve. Transaction costs for alternative currency systems decreased as participation volumes increased. Network effects that had previously reinforced dollar dependence began operating in reverse. The system doesn't fail here, it tightens. What emerges is a structure operating beyond traditional monetary theory. Dollar dominance persists not through economic superiority, but through infrastructure dependency that makes alternatives structurally expensive to develop. Countries continue accumulating reserves they know can be frozen, because the coordination costs of collective action exceed individual transition risks. The artificial scarcity mechanisms that created dollar strength now generate the exact pressures that force alternative development. Each sanctions application accelerates de-dollarization research. Each infrastructure restriction increases investment in parallel systems. The same network effects that entrenched dollar dependence begin operating in reverse when sufficient participants reach critical mass simultaneously. Markets continue pricing dollar assets as if demand derives from economic fundamentals, when the actual foundation rests on agreements between specific parties under specific conditions. The constraint structure that prevented individual defection becomes vulnerable when multiple major economies absorb transition costs collectively. Yet confidence in dollar stability remains intact because the visible indicators still support the traditional narrative. Reserve accumulation continues. Trade settlement volumes remain substantial. Alternative systems handle growing transaction volumes, but haven't reached operational parity with dollar infrastructure. The mispricing exists in the gap between perception and mechanism. Markets assume dollar demand reflects American economic performance, when it actually reflects exit costs engineered to exceed staying costs. When those cost calculations change through coordination effects or infrastructure development, the assumptions underpinning current pricing require re-evaluation. This is what remains unpriced for now.